know, many of you were here last year. One of the topics that I covered was the Brexit, and that's the Greek exit of the European Union. Now, that was in the news a lot in 2015, and it had some influence on markets during that short period of time. And as we can see in the cartoon up here, this is an event that never actually occurred. Now, what did occur this year is the United Kingdom voted to leave the European Union. So we're going to talk a little bit about that topic. The Brexit has seemed to fall out of the current news cycle, right? So why are we talking about this? Well, one of the reasons why it's not in the news cycle and heavy rotation right now is there's nothing to really talk about yet. This is an event that won't start to unfold until 2017. So then we'll get to hear a little bit more about what's going to occur, and that can have some implications on global markets as well as asset returns. So that's why we're covering it. So our agenda today, we're going to take a look at the United Kingdom's footprint relative to the rest of the world. We're going to take a look at some of the results from the voting. We're going to look at initial market reaction, both in terms of currencies as well as equity returns. And then we're going to evaluate any potential impacts either on global economies or as well as client portfolios. So let's get to the footprint. So here we have two charts that gives us a sense of the UK relative to the rest of the world. On the left-hand side, we have the percentage of world GDP. We can see the big kid on the block is the United States in the red, and that's 22% of world GDP. By comparison, I think it's gray, perhaps the gray piece of chart is the United Kingdom, and that's about 4% of the world GDP, so that's a much smaller piece of the pie, right? Now, if we look at the right-hand side, this is the international equity universe. We can see that the United Kingdom has a larger portion there, and that's about 12%. So most institutional portfolios can have anywhere from the low teens to the low 20s in terms of percentage exposure within their international portfolios. So that means that there's potential to affect client portfolios here. Now, a major part of my job is meeting with investment managers, and I do this a lot. We saw some stats on manager meetings, right? So I do part of that. And one of my favorite parts about this job is I get to hear a lot of different opinions on a lot of different topics. So to give you an example, one of the questions that I'm asking investment managers over the last several months has been about the financial sector, okay? And Jim talked about some of the troubles within financials. But I might hear one group that tells me about how cheap financials are, how low the valuations are, and how their balance sheets are so much more improved than they were in 2010, 2011, and it's buy, right? But I might hear another group that talks to me about the low interest rate environment and its negative effects on being able to generate earnings growth in the near future, or about the changing regulatory environment and its effects on profit margins and its sell. So that's an example of different opinions that I'll hear from different groups of managers. Now, in the early part of the year, the question I was asking everybody was the Brexit. So they all got the same question, and every single manager had the same answer, and every single manager had it wrong. No one thought that the Brexit was going to happen. So this was really a shock to markets and investors. Now let's take a look at some of the results. So the Leave camp won 52% of the vote, with the Remain camp winning 48%. So it's a pretty close decision there, right? Now, in terms of voter turnout was high. It was at 73%. Now, to put some context around that number, the most recent national elections had a voter turnout of 61%. So the implication here is that despite the close margin of victory, because you have a higher voter turnout, it further solidifies that decision. So it makes it less likely to see any type of second vote. So in other words, Brexit means Brexit, and that's the words that the Prime Minister used. So looking at some other results here, older voters generally decided to leave the European Union, while millennials, now, that's a term that you're going to hear Jeremy Zirin talk about and define for you, so I won't define that. But younger generation voted to stay within the European Union. It was pretty significant numbers there. On a regional basis, we had Northern Ireland and Scotland that voted to remain, and then England and Wales that voted to leave. So there were some pretty significant divisions based on where you lived and how old you were. Now let's take a look at the initial market reaction, and we're going to take a look at this in terms of currencies as well as equity returns. Now, Nat had a similar chart to this, and it's so good that we're going to use it twice, but the British pound fell immediate following the Brexit event. okay? And as I said, all the managers got the Brexit wrong, but I do have to give them some credit here. They did say that if the Brexit was going to occur, that the British pound would fall. So there's no real surprise here. This was expected to happen should the Brexit occur. Now, looking at equities, stocks across the globe fell in the 2 trading days post-Brexit decision. The S&P 500 and the emerging markets index dropped 5% in those 2 trading days. International developed equities dropped 10%, so some pretty significant losses. I know all of you follow market movements on a minute-by-minute, day-by-day, week-by-week basis, so I know that equities bounced back pretty good after these 2 trading days. The next 2 charts are going to help explain why we saw some of that bounce back. Now, when you look at equities across the globe, in general, stocks have very little revenue exposure to the United Kingdom. The S&P 500, which is on the left-hand side, has less than 3% of revenue exposure to the UK, so less than 3% sales. On the far right-hand side, you see the emerging markets has less than 2%, and then Europe, which has a close trading relationship with the UK, has less than 6%. So overall, I think if you go back a couple of slides and you remember that the United Kingdom represents 4% of the world GDP, these numbers match up, pretty well. So there's no major surprises here. But if we look at the next chart, I think it might catch more people off guard. So if we're looking at the MSCI UK index, so here we're talking about companies within the United Kingdom, 72% of their revenues come from outside the United Kingdom. 28% are coming from the UK. So many of these companies are large, multinational companies that have diversified revenue streams from across the globe. Now, one example of a company is Diageo. You may be familiar with this firm. It's based in London. They sell spirits throughout the world. You may know some of their brands. There are good friends, Johnny Walker, Captain Morgan, and Don Julio. And 34% of their sales come from North America. 20% come from the Pacific Asia. And so this is just an example of a company, a typical company within the United Kingdom that's large and has multinational, different revenue streams across the world. So as markets were able to digest some of this fundamental data, that's one of the reasons why we saw equities rally after June 27th. And if we look at performance from June 27th to the first week of September, when we put all these books together, the S&P 500 was up 9%. The UK and international equity developed markets were up 14%, and emerging markets were up 16%. So some pretty strong numbers there. Now, we've examined stock exposure via revenues. Now let's take a look at economic exposure via trade and trade relationships. So these 2 pie charts examine the trade relationship between the European Union and the United Kingdom. So let's take a look on the right-hand side. We see that 44% of the United Kingdom's exports go to the EU. That's a huge piece of the pie, 44%. On the left-hand side, we see that 6% of the EU's exports go to the UK. So much smaller, but still a significant partner there. Now, the key takeaway here is that the UK relies heavily on the trade relationship with the European Union. So it's going to be very important for them to reach good trade terms for how they're going to exit the European Union. Now, let's talk a little bit about that process, right? I said early on that we haven't seen a whole lot happen here. And the reason for that is the first thing that needs to happen is the UK needs to make it official. They need to notify that the EU that they will be leaving, and this is known as invoking Article 50, and this is yet to happen. Now, the current prime minister has said that they plan on doing this in 2017, okay? So there's still some time here. Once the UK makes it official, in their trades, they're gonna be faced with a trade-off, okay? They're gonna have to make a trade-off between having access to the European Union as a market and having independence from the European Union. So to give you an example, what that means is the United Kingdom, if they want to control their borders and limit the movement of free trade across regions, where they're gonna have to give up something for that. And maybe that means higher tariffs when they're dealing with trade with the European Union, or maybe it means more financial contributions to the EU budget. So there's gonna be some trade-off here, and that's something that we're gonna be following. Now let's take a look at other economic exposures, other trade relationships. So this is looking at outside the European Union, exports to the UK. On the far right-hand side, we see that the United States has less than 1% of its exports to the United Kingdom. So in terms of the Brexit, there should be a very minimal direct impact to our economy here in the United States. Now, there are some countries that have larger exposure to the UK from a trade perspective, and those are on the left-hand side. You see Belgium, Netherlands, and Ireland. So they would be more susceptible to a slowdown in the UK's economy. Now, previous to the Brexit, the United Kingdom was actually one of the stronger performing developed regions throughout the world in terms of economic growth. So their GDP annual growth rate was at 2.1%. But with the Brexit comes uncertainty, and economists are now projecting their growth rates to fall to 1% or the high decimal ranges. Now here we have a chart that looks at Purchasing Managers Index. Okay, this is just an economic indicator. You see the blue and red lines, servicing, manufacturing. If you see it above the black line, which is a 50 reading, that means the economy is expanding. If you see it below that black line, that means the economy is contracting. So you notice that immediately following the Brexit in July, we saw that fall below the 50 mark, right? And then in August, it bounced back up. Well, what happened in August? Well, in early August, the BOE, or the Bank of England, came to the rescue. They said, you know what, we're going to come in and we're going to cut 25 basis points. We're going to reinstitute our bond purchase program. We're going to buy corporate bonds. We're going to buy government bonds. And the market's like that, right? So what's happening now, and Jim talked about this, but the BOE, or the Bank of England, is joining the ECB, or the European Central Bank, and the BOJ, or the Bank of Japan, in these stimulus measures, right? These stimulus measures, especially outside the United States. Now, the BOE has committed to not using negative interest rates in their policies, whereas the BOJ and the ECB are using negative interest rates. But still, these stimulus measures are putting downward pressure on interest rates, right? Downward pressure. And here we have negative yielding interest rates marked here in the green bar. And if you go back to 2013, take a look and see if you can find that green bar. You can't, because, as Jim said, there's been no negative yielding interest rates. It was 0% back then. And we fast forward now to 2016, and now it's 38%. And again, it's important to note that all of this is outside of the U.S. There are no negative yielding bonds in the U.S., so this is all outside of the U.S. But this negative interest rate environment, or this low interest rate environment, can influence asset class returns. And investors are more likely to continue to search for yield, look for higher yielding assets, maybe take on a little bit more credit risk. And then from an equity perspective, you're looking for higher yielding, dividend yielding companies, or looking for more sustainable growth type companies. So that's how it's kind of influencing the market. It also has implications for expected returns going forward. And Greg will talk a little bit about that in his last flash talk. Now, another influencer of returns are politics, and Nat did a great job of covering the U.S. elections, so I can't add anything there. But there are some other elections that are occurring outside the U.S. that can influence market sentiment. Germany and France have some national elections that will be occurring in 2017. Later this year in October, Italy will be voting on some constitutional reforms that their prime minister has offered up. And so the key question here is whether the United Kingdom will be the only group to leave the EU, or whether it will be the first group to leave the EU, okay? And these elections and votes will determine what parties are in power and whether they're supportive of the EU. Now, what we'll say is that it's very unlikely that we would see other countries or other groups leave the European Union. The UK was a little unique. They didn't even adapt the euro. But people don't expect other countries to follow. But it is possible. This is possible to happen. So, last year I talked about the Brexit. This year I'm here discussing the Brexit. So the question is, what's going to happen next year? So it's possible that I could be up here talking about Quit Italy, could be speaking to you about Sweden, or perhaps We Out. I grew up in Texas, so I'm personally rooting for a Texit, because I think it would be great to do some research on Texas, spend a lot of time learning about that great state. But so that's a joke. But this is, there is a possibility of this, and we view this as a tail risk. So it's something that we're following and something that we're monitoring on an ongoing basis. And as we get into 2017, the political landscape will start to become a little bit more clear, and we'll get to see what's going on with the Brexit. So let's hit the key takeaways. Again, expect a 2-year process, and that actually process can drag out, but expect at least a 2-year process for Brexit to kind of get resolved and to see what happens there. Again, minimal direct economic impact to the United States. We showed some statistics around that. The other thing maybe I haven't talked about yet is this is going to complicate the Eurozone recovery story, right? So if you look at 2015 going into 2016, the Eurozone was starting to look good. It wasn't great, but it was improving. But this uncertainty around the Brexit really starts to complicate that story. Expect volatility. We have political events. We have the Brexit. So you'll see volatility as kind of news comes out. But with volatility generally comes opportunity, especially as winners and losers are sorted out in the new environment. And then we talked about monetary policy. Expect loose monetary policy. Expect low yields, low interest rates into the near future. And that has implications for expected returns kind of on a 10-year basis.